Super. So I've got the pleasure this morning of introducing our speaker from Schroder's, Olivia Geldenhuys. And Olivia's focus today is going to be on, is active management dead? And focusing around the 3D reset, being decarbonisation and climate change, deglobalisation, so New World Order, and demographics, our AI, intelligence, etc. So Olivia's going to run through her presentation, which will be about 30 to 35 minutes. And then we'll have a chance at the end to raise any questions. So there's a Q&A button at the bottom of your screen. So if any of you would like to raise questions throughout the presentation, then please do so via the Q&A button. And then when we come to the end, I will pose those questions to Olivia, and we'll be able to get some answers and some further information on them. So looking forward to today's presentation. I'm sure it's going to be really interesting. And without further ado, I'm going to hand you over to Olivia. Thanks very much.
Thanks so much, Linda. It's great to be here and to have the opportunity to speak to everybody. So please do pop questions through into the chat box so we can answer them afterwards. But really what I'm going to take you through today is this overview of whether or not active management is dead. And it's a thought-provoking kind of question. If we move to my first slide, you'll see that the evidence actually suggests that it is dead. I mean, if we think specifically about the US, active managers are really criticized significantly for not being able to beat the benchmark. And I mean, I think we can all relate to a 2023 where that benchmark was incredibly difficult to beat because of the high levels of concentration. So although the evidence suggests that active management is dead, if we look at the next slide, you'll see that really the devil is in the detail. And where we can start seeing this information start coming out is a very useful report produced by Morningstar, which is the active passive barometer. And what the active passive barometer seeks to identify is what is the percentage of active equity managers that do actually outperform a passive equivalent. And now I've got some interesting stats on screen here where we can see what is the difference between your large cap US equity versus your small cap. And so, largely the US is kind of stated as being an efficient market and a market that, sorry, do you mind if I just 2 seconds?
Hi, Olivia will carry on in a sec. Obviously, some technical difficulties. I'm sure she'll be back with us any second now. So if you just bear with us for one moment. And also the slides will be distributed to everyone. So after the presentation, you'll be able to get a hold of these slides and have a look at all of these interesting stats in more detail as well. I have a feeling that perhaps she was in a room that she needs to move from. So yes, we've got Olivia back.
Apologies about that. I seem to have booked myself into the wrong room. So it's interesting when you start looking at this across the cap spectrum in the US that we then do start seeing these differences come out, where actually your small cap managers are able to outperform a passive equivalent. And that starts suggesting something to us that maybe we can't view this active and passive debate simply as a black and white type of situation. And we actually need to think about where are there pockets where we potentially can see active management outperform, and where are there areas where passive management is perhaps better suited. So if we just move to our next slide, you'll see that this is something that we can do a lot of analysis on in identifying where are those markets that are more efficient versus those that are less efficient. And the big difference that we actually see between these two markets is really about price discovery. And so price discovery comes from where there is an environment where information is maybe not readily available, or there isn't as much coverage. So there aren't as many people looking at a specific market. There aren't as many eyes on it. And that then produces something where we can then identify opportunities for alpha. So these are about finding companies which the price reflected in the stock market is actually not a true reflection of what those companies are worth. And so that price discovery tends to exist a lot more in your less efficient markets. Whereas in your more efficient markets, and again, if we think about the US at that large cap level, everybody is thinking about the Mag 7, right? Everyone is paying attention to that part of the market. And so price discovery is quite difficult to beat. Whereas if we look at your less efficient markets, and a good example is obviously emerging markets. If you can't tell from my accent, I'm from South Africa, and that is definitely a less efficient market versus what we see in the UK, certainly, and certainly in the US. And so there is a lot of room for price discovery in that environment. And if you just move to my next slide, you can see how we start seeing this play out. And it's very topical at the moment because we've seen such high levels of concentration. And, the Mag 7 making up more of the ACWI versus 4 other countries is quite an astronomical statistic that we can look at. And it seems to be ever growing. And so this trend that we then start seeing, if we look at the divergence between something like the US and your emerging markets, is the emerging markets tend to have a much lower level of correlation, of concentration rather. And it's not to say that there isn't any concentration, but it's certainly at a much lower level than what we've got in the US. Now, why does this concentration matter? It matters because it becomes a very difficult area to outperform when there are high levels of concentration. And this is something where we can then benefit from active management. And so if you look at our next slide, you'll see we're looking at what is the 5-year return that we have typically seen from an equally weighted S&P 500 versus the market cap S&P 500. And what we see when there is such high levels of concentration, it actually becomes quite difficult to outperform. And so what you want to do is you want to identify, if we look at that equally cap weighted S&P 500, those are the dots towards the right, where it then actually becomes possible to have significant outperformance when there are those high levels of concentration, because we're not just allocating to the large cap stocks at that high concentration level. And that then produces a different way of actually outperforming. And so if we move to our next slide, you'll see that really we need to think about what are the differences between active and passive. We're not going to look at this through a black and white lens where there is only one or the other. It's about identifying where there are opportunities to actually use both. And so if I bring it back to my very first question, is active management dead? I think the definition really is about thinking, what does active management mean? Simply buying a passive tracker, and if you only bought the S&P 500, that would be a passive decision. But the moment you start allocating across different indices, there is actually a lot of active decision that's happening in that space. And choosing which indices you want to invest in is also something that you can start analyzing and identifying where are the opportunities for that type of strategy to outperform versus the strategy of active management to outperform. And so you can see the summary that I've got on both sides there. Your passive markets are best utilized in markets that are very efficient, whereas your active funds are best utilized in markets which are inefficient, where you can actually take active weights in the positions that you hold, and there is that room for price discovery. In contrast, obviously, we then have your passive funds, which have more of the information actually priced in. And so there isn't that room for price discovery. And holding market cap weights is actually something you benefit from as we see momentum increase in the marketplace. And so these are the definitions really of active and passive. And I appreciate I've taken it back to basics, but I think it's useful when we look at then the context of what we are at Schroder's calling the 3D reset. And so if we look at the 3D reset, like Linda mentioned earlier, there are 3Ds that we see that are reshaping the investment landscape. And if we just look back at history, it's something that has shown us where we had 30 years of low inflation. Those numbers were, close on the 2% targets. Bonds were an asset class that always went up. And portfolio construction largely was easy because the correlation between both equities and bonds meant that they performed in inverse ways. And so if you then allocated to both equities and bonds, if one was going down, the other was going up. And that made creating a portfolio very easy. But I think we can all identify that we are not in this cycle anymore. We are not in that period of low inflation. We just need to reflect a few years ago where transitory inflation was something that was being bandied about. And now it's quite clear that that wasn't actually transitory. And we are seeing very sticky components of the inflation really holding out and not coming back down to those levels. We saw bonds fall dramatically over 2022, 2023. Those prices really causing a massive shock for investors, especially if I'm thinking about your investors that are in your low risk portfolios, where in those low risk portfolios, they typically held more bonds. They were used to having a stable level of return. And now they then saw their portfolio values fall. And that idea of correlation between equities and bonds also began to be challenged, where we saw actually that equities and bonds were very highly correlated over the last few years. And so if we just look at my next slide, we'll see that the 3Ds that we're talking about and how these are going to reshape the landscape are decarbonisation, deglobalisation, and demographics. And these themes are already underway, but they're going to be long-term trends for us. So let's start with our first D. Decarbonisation, or the acceleration of climate change, is something that we have been talking about for quite some time. And there is going to be more change coming in this space. And I think it becomes quite clear when we think of something like the Russia-Ukraine invasion, where all of a sudden those geopolitical tensions caused a spike in energy that made everybody start thinking about how resilient are their energy supplies? Are there any energy supplies that are actually at risk? And it really brought this to the fore that we do need to respond to climate change, and we do need to think about what are the other factors that are going to affect the sustainability of being in a decarbonized world. But one of the things to remember in this space is that there is going to be greenflation. And this is essentially as we transition into a decarbonized world that we actually see inflation spiking, because in the very beginning of a new type of technology, the supply and demand factors don't match. And so we tend to see that those do come at a higher price until they become more normalized and they become a system which is very easy to actually produce. And we can then start seeing those prices actually come down. But initially, we are going to see an increase in inflation from that perspective. And so if we look at my next slide, you can see some interesting stats on how this has actually changed over time and how we're starting to see this demand for renewable energy sources actually spiking as we move forward. And if we forecast that into 2040, we do see that number coming up quite significantly. And then we would expect, obviously, to see things like your oil and gas come down and like coal requirements come down. If we look at this in a little bit more detail on the next slide, you'll see that the composition of what we've experienced in this transition for clean energies is we are going to start seeing that accelerate. And there have actually been two previous energy transitions where we saw traditional biofuels actually come down in demand, where those weren't as high, and we then started seeing the demand for coal actually increase, as well as oil and gas. And now we're starting to see the same shift happening with the renewable energy space. We're starting to see those levels of demand actually tick up. And if we look at our forecasts, we expect that to accelerate quite significantly. Now, it's not just about the demand for clean energy. It's also about thinking about climate change as a concept and what that might actually do to productivity. And this is something that Schroders have written about extensively, is what is the impact going to be on productivity? And we've really broken it down into three areas. There's the physical cost of climate change, and that means that as temperatures increase, it becomes a lot more difficult to actually be productive. Now, in the UK, actually, we'd be set to benefit from a slight increase in temperature, no least because I'm sure it would make everybody a little bit happier if the sun was out and the sky was a little bit more blue. But this is a country which can actually benefit from a slight increase in temperature. Whereas if I think of South Africa, that's a country which is already very warm, and it tends to be your emerging markets which are already warm. And if the temperatures continue to increase, that actually negatively affects their productivity levels. And that ultimately then has knock-on effects for how those economies are able to then generate returns and actually grow their economy. And so that leads us into the second cost, which is the transition cost. And so as we start needing to, employ carbon taxes, those are expected to increase. And the transition from your oil and gas and your traditional biofuels, coal, etc., that then actually has to transition into being in this renewable space. And that comes at a cost. And then lastly, stranded assets, which is a very interesting concept because you can think about it as writing off bad debt in a balance sheet, where essentially countries that have lots of fossil fuels, those are fossil fuels that are going to stay in the ground potentially and not be worth as much as they typically were because they're no longer needed in a green economy. And so all of this, there is the impact of, an investment source where we can invest in renewables and we have the opportunity to generate alpha in places like clean energy. But then there's also the actual effects of climate change and how that might affect overall productivity. So if we look at our next D being your deglobalisation, and again, COVID really brought this to the fore as we saw supply chains really being challenged. We saw a lot of supply chains needing to actually be reconfigured in where they were getting their supplies so that they could continue to actually support the demand. And this is something where we're actually going to see a new world order come out. Supply chains were heavily concentrated in places like China, and now maybe we'll start to see that actually shift. But again, as we see this change happen, this is also something that can affect inflation. And so let's dive into deglobalisation a little bit more. If we have a look at what is being mentioned in earnings reports, a lot of reshoring is being mentioned, and it's certainly spiked, as you can see, 2017, 18, etc., very low. And as we moved into 2020, the COVID era, where we did need to start questioning this, reshoring and onshoring, or nearshoring, all of those terms were now being used in your corporate earnings reports, and that spiked again in 2022. And so this is something that we need to really pay attention to, because it changes the dynamics of how the market works. And so if you look at our next slide, you can see again a little bit more detail about where are the winning markets in this world of deglobalization, and where those supply chains then ultimately start adjusting. Like I mentioned, China, that was where a lot of supply chains were coming from. Now we see places like India actually set to benefit, places like Vietnam, and there's different ways that we can actually assess what are the markets which are potential winners of this. And so we've established a framework on how we assess this. And it's things like business freedom. It's things like your working age population, which you'll see will take us into our next D as well. And it's really looking at how productive can each of those regions be, so that they can generate areas of growth within those economies. Now, this is, as you can imagine, not something that happens overnight, and it will take a long time, and it'll be over multiple years. From an investment perspective, we want to really position ourselves to take advantage of each of these areas. And so if we just move to our next slide, demographics is something that's become very topical as well. And demographics is largely about the labor force, and where are they areas where we're seeing a large increase in the aging population. So these are people who are actually going to start falling out of the labor force. And when there aren't enough young people to keep things going, that can then also have a negative effect on the economy. But what we do see is things like productivity boosting technologies. So if we think about AI, I know, it was really only a year ago, maybe 18 months ago, we were talking about things like ChatGPT. And I was on the train on the way home the other day, and I heard someone speaking about what they were using ChatGPT to do. And it's starting to become a lot more mainstream. And this is really going to enhance our productivity, which again means that we can be more productive and actually generate higher returns at a global economy level. And so if we look at the underlyings of demographics, we can see that the aging population is something that is going to have an effect on the overall economy. They're still going to be spending money. They're not necessarily making money from employment, but they do require pensions. They require investment income to a certain extent. And then they are still actually going to be spending. It's just where they spend is going to be different. So in this instance, we can think about things like healthcare. There might be a greater spend in that type of area. And so again, that provides us with an investment opportunity. And so if we look at our next slide, you'll also see that we're potentially moving into a fourth industrial revolution, where we are starting to see the network effect of efficiencies that are created by things like AI, by things like large language learning models. And again, this is going to influence the global economy. And you can see there on screen, I've just got the stat from McKinsey, where they estimate that generative AI could generate anything between 2.6 to 4.4 trillion to the global economy. And this is something that's really starting to take hold. And we want to be, from an investor's perspective, we want to be at the forefront of that and making sure that we're taking advantage of those opportunities. So appreciate that I've now thrown a lot of information at you about how the world is actually changing. Let's look at some of the practicalities for what can be done with this. So where are the opportunities from an investment perspective? And the first thing to think about is the fact that there are the 3 Ds are your highest level long-term trends. But underneath each of those Ds are macroeconomic outcomes that we see for investors. Now, when I was looking at this again, I thought, it's really 1 and 2 that have played out. And then you think, no, but 3 is definitely still there as well. We're still seeing volatility. Politics is now starting to take hold. We're in an election year where half of global GDP are going to be voting. We've already seen the shift of supply chains, and technology, like I said, is something that is really starting to come out. Now, what I like about these outcomes that we can think about at a macroeconomic level is it gives you a framework of thinking. It means that when we think about things like higher inflation for longer, what does that actually mean? If there are areas where there are labor shortages, do we want to invest in those areas? Are there companies that are in that space that are actually creating change, taking advantage of things like investing in technology so that they're not subject to labor shortages, where they actually can take advantage of things like technology to continue at the same level of productivity? And so this then helps us to think of a framework and how we can actually target our specific investments. And if we move to our next slide, you'll see that I think we've got to think about what are the tailwinds, the headwinds, the crosswinds. What are all the things that come out of these macroeconomic outcomes? And really, it's about the disruption. It's this regime shift that we're in, where we're actually moving into a new world, and we're all starting to get used to it from both a personal and professional level. And so when we think about investing, it really becomes very key that diversification is important in these instances. And it's not just about diversifying and saying, okay, we're going to allocate to equities, bonds, alternatives, etc. It's looking within each of those different asset classes and identifying, how do we actually generate the returns? What is the path of returns going to look like? And certainly for advisors who are investing for clients with long-term goals, you want to have as smooth a journey as possible. You don't want to see these big shifts upwards or downwards. You want to make sure that you're essentially ticking along so that you compound on those levels of growth that aren't extreme, which means that typically then your drawdowns are not extreme either. And so making sure that you have that flexible approach is going to be important. And so if we then think about how this actually moves on into navigating this environment, the economy tends to go through these 4 different phases: expansion, slowdown, recession, recovery. Some might argue at the moment we've been speaking about recession for so long, but we seem to be skipping it or just only lightly touching on it. I know there's been lots of mentions of hard landing and soft landing, or no landing at all. And so navigating this can be challenging, but this is where diversification continues to show its benefits. And there are going to be certain asset classes and certain parts of the markets that benefit in each of these different environments. And making sure that we're positioned for each of those is obviously critical to achieving those long-term goals. And so let's start thinking about what this means for actually investing, and how we actually then build these portfolios. How would we actually construct a portfolio in this new world? Now, I don't need to remind advisors, but obviously there is a very important factor, which is actually staying invested. And I know that when things are volatile, there is the desire to do something, the desire to move. And we've had lots of conversations about moving into things like cash and feeling that we need to go into something that is safer when there is a lot of volatility in the marketplace. But realistically, if we look back over the longer periods, we can see that outperforming inflation requires you to invest in things more than cash. And so equities is obviously the prime example, where over a 20-year time frame, and that's looking back over the last 96 years, that has been inflation beating 100% of the time. Even cash, though, has been quite interesting, because cash is not, you're investing in something which is actually not generating a return. Even in that instance, we're seeing that you're getting 66% of the time that you would have outperformed inflation. Now, 66% versus 100, I think I'm going to go for the one that is higher. And so making sure that you have a balance which is appropriate to the level of risk that you're willing to take on is something that's going to be important in overall portfolio construction. And so if we just look at our next slide, you can see that strategic asset allocation is where it all starts. Now, I spoke about correlations a little bit earlier and how we've seen correlations shift over the last 2 years, certainly between equities and bonds. But interestingly, the equity and bond correlation has been quite volatile over different periods. So this goes back all the way to 1900 up to 2022. And it's really only for the last 24 years where we've actually seen it in that negative correlation space. And now we've re-entered the positive correlation between equities and bonds. So this is not about having a static strategic asset allocation. This is about identifying a strategic asset allocation which is fit for purpose right now, but then keeping your eye on it annually, I'd say is a good suggestion. Look at it on an annual basis and adapt to it based on what we're actually seeing play out in the market space. If we think about the expected returns on cash, the long-term expected returns on cash have increased over the last 3 years. And so that then has knock-on effects for what we expect as long-term returns from things like bonds, things like equities, and things like alternatives. And so when you look at it, if you had looked at your strategic asset allocation 5 years ago and you hadn't adapted it, you're potentially sitting in something that isn't actually fit for purpose in this regime shift and within the market of the 3Ds. And so we've got to then think about how do we actually best utilize each of the asset classes within this portfolio once we've established that strategic asset allocation, kept our eye on it, and updated it as the world has changed around us. So the first asset class that I'm going to start with when we think about building these portfolios is really about what is the role of bonds. And now, as I've mentioned before, we are starting to see that the expected returns for treasuries is something that has increased over the last few years, and we're now actually expecting higher levels of return from that asset class. But it's not confined purely just to treasuries. We are seeing other areas of the bond market come out. So things like your high yield, obviously, is something which has seen significant increases in the yields that are now on offer. But high yield also comes at a level of risk. And so we prefer certainly to allocate to things like investment grade credits, which is credit from companies that are less likely to default, are more able to actually service their debt obligations. And we feel that you're still getting a very good yield in that space, but there is a safety net as well of the types of companies that are actually issuing that debt. Things like emerging market debt is also an interesting area. And again, those countries, if we look at their rate cycle over the last 3 years, has been slightly different to what we've seen certainly from the US. They did actually start raising rates a lot sooner. And so that then also provides us with an opportunity to generate higher yields in that space. The next asset class that I want to have a look at is your equities asset class. And equities is something where we then have to be very selective. Like I mentioned, if we think about your active and passive, where are the opportunities to allocate to active, and where do you want to allocate more to passive? But essentially, an inflation environment is actually good for profitability. And another area where we can look at for that is Japan. Japan have now exited this disinflation environment. They've exited negative interest rates. And now, for the first time in decades, it's 30 years that they've been in this space where Japanese companies haven't been able to actually increase their prices, which means that they've been hoarding a lot of cash to be safe, and now they have the opportunity to actually increase prices. And that is then supported by wages also increasing as we see those inflation numbers increase. So it creates a bit of a virtuous circle where we can then actually see when there is that inflation boost, that prices can then be raised as long as they're supported by wage increases, and that then creates a higher level of margin. And we can see how that's played out in the US as well. But also something that's interesting to look at is what is the relationship with PE multiples when we think of them relative to things like inflation. And actually, when we have seen those high levels of inflation, we do actually see lower PEs. And so that's also something that's important to pay attention to. At what cost are you actually getting these levels of return? And the last asset class that I want to look at is alternatives. Now, alternatives is a very interesting one because it's a very broad asset class and it can cover so many different areas. So what I thought I would do is I would just give you our definition as we think about it at Schroders. And for us, we really want alternatives to have a low correlation relative to both equities and bonds. And the reason we wanted to have a low correlation is because we think that we're going to be in this more volatile environment and we're going to see equities and bonds perform in different ways. And we want alternatives to provide protection within a portfolio. And so when we are thinking about that downside protection, it's about not falling as much when equity markets are down. But that also means that when equity markets go up, you potentially don't benefit as much from the upside of it as you did protect on the downside. And the reason we've decided to give alternatives a definition of this, so the pure definition that we have for it is less than half the beta of the equity markets. And the reason we've done that is because it also allows us to be dynamic in how we allocate to alternatives. So alternatives, typically people would have thought, I'm going to allocate a bit to gold. Great, gold is interesting. It's a bit of a hedge. Certainly in a geopolitical environment, it can be a bit of a hedge. But gold doesn't have a yield in the same way that fixed income does. So it then is something that is quite different to fixed income, but it's not the only alternative asset class available. People also think generally about commodities. And so that does form part of the alternatives components. But where we're really starting to see a benefit is allocating to things like hedge fund strategies, things like trend following strategies, which are going to follow shorter term trends in the market and then take advantage of volatility as it plays out to generate alpha in that space. And that's something where we feel we can also benefit in that environment. But having that clear definition means that we can be dynamic in whether we allocate to things that are going to diversify away from the risk, or when the market starts changing, we can then actually use it to boost returns by investing in those types of strategies as well. And so if we can just move to my last slide, which is to thank you. And if there are any questions, I think, Linda, I've just hit us on the nail on 30 minutes.
Perfect, brilliant. Thank you so much for that, Olivia. Really interesting. I particularly personally like the encapsulation using the 3Ds as a way to sort of understand the type of world that we're moving into and to put some context around that. I think that would be useful for our advisors that are listening in a way to explain that to their own clients as well. So thank you for that. And as anticipated, we have had a few questions come through. So I will just read through them. So the first one that's come through, Olivia, is what do you think are the key factors that investors should consider when deciding between a passive and an active investment strategy?
I love this question because I know everyone wants the black and white answer, and I think I did make it quite clear that that's not necessarily something that's available. But the way that I like to think about it is I like to think about what is the philosophy that you believe in. Now, I know that maybe sounds a little bit fluffy, but if you believe that paying for active managers means that you are paying for skilled individuals to spend all day, every day, looking at the markets, identifying opportunities to invest in, identifying companies that they think will grow, and essentially these people are being paid, that is their job, that is what they do every single day, it's what they're passionate about. If you believe that that actually adds value, then invest in it. If you believe that that doesn't really work and it's not going to be beneficial and no one can really identify companies that are going to do well, sure, maybe they find some companies that they think will do well, but they then offset that by investing in companies that then don't do as well. If you have a fundamental disbelief in that process, then things like passive strategies are a good option, because that's you buying the market, it's really easy, invest in the S&P 500 and leave your money there. But what I would caution is each of those philosophies come with a different investment journey. And what you tend to see, if you look at some of these stats over the long term, and I'm speaking specifically of a multi-asset portfolio, it's difficult if you start looking at individual asset classes. But what you tend to see is things like a passive type strategy, as multi-assets, tends to have higher peaks in performance, but also it has lower troughs. And the reason for that is because you're exposed to market cap weights, you are then push and pulled with the momentum of the markets. So S&P 500, we'll use that as the deep dive example here. 2023, stellar year, shot the lights out. We seem to have forgotten, though, that 2022 was the complete opposite. And it did not do that. And it was a detractor for a lot of that period. So the journey that you're actually going to feel with something like a passive investment will give you those upsides, but it also comes with those downsides because the momentum of the market pushes it in that direction. What active managers do is active managers mitigate that slightly because they're specifically making calls on things, which means that you don't get as high peaks, but you also don't get as high as deep troughs when the market is down. And so that's why the answer is not black and white, because my firm belief is if you believe in the investment strategy that you've invested in, you're less likely to capitulate, which means you stay invested, and that is a better outcome, whether you've chosen to go active or you've chosen to go passive. Strategic asset allocation and staying invested is going to be the thing that actually gets you to the end goal. And if you're going to be forced or shoehorned into something like an active strategy where you don't believe in it, then you're going to be more likely to capitulate when things are tough. Whereas the S&P, you can kind of just say, what's the market? It's how it moves. So I think there's the investing aspect, but I also think that there's the behavioral aspect of staying invested.
Absolutely, absolutely. Thank you so
So
much.
that's a very long answer for a question which I think sometimes we oversimplify, right? It's not that simple. And that's why certainly for us, we've seen things like blending active and passive has been popular, because sometimes people aren't that sure whether they believe in active management, but they're also not sure that they completely believe in passive.
Yeah, absolutely. We see that across the platform as well. The blending is popular also. Brilliant. We've got a couple more questions. Someone's asked how do you identify the opportunities arising from the 3D trends that you've spoken about across the presentation?
So I think, like I said, the 3Ds for me is about creating that framework, because there is so much going on and it's very difficult, but it's those macroeconomic outcomes that sit beneath it. So it's those 5 outcomes of, if we're in a higher inflation for longer, if there is tighter monetary policy, what are the advances in technology? So I'll choose technology as a good example, because I think that's where we've seen a lot of popularity at the moment, and we've seen that reflected in share prices. But essentially, when you think about those macroeconomic outcomes, you're thinking about where are the areas that are going to benefit. So what are the types of investing strategies that you can actually employ that are going to be looking at those specific areas and identifying the companies that match that? Now, we do multi-asset investing, so we're investing at a fund level. So I'm not going to talk really at kind of a stock level. But the way we think about it, and the example I'll give you is in our global equity components. So in our global equity components, we use this to actually invest in thematic funds. And thematic funds are then looking at underlying companies based on these trends that we're seeing. So one of the managers that we use, for example, has 6 themes that they follow, one of which is called Bits of Chips, which I love because it's always nice when you've got a catchy name to something. But Bits of Chips is a theme dedicated to identifying the winners in the AI race. So they're looking at who are the chip makers, who are the chip makers supplying, who are the suppliers to the chip makers. What does that entire value chain actually look like? And where are we going to see the most benefit from a share price, but also based on the companies that they're actually investing in, who are going to be the best companies to invest in that space? Because as we start seeing this change come out, they're then going to be looking at who are the upcomers, who are the new entries into this marketplace. NVIDIA has dominated it, but as it starts becoming more mainstream, we'll start seeing more people come out and more businesses being launched in that innovative space. So when I think about the 3Ds and how we position that in our portfolios, we look for within each asset class, we look at which are the types of drivers within that asset class. So if we look back to concentration in the US, it's heavily concentrated in things like technology companies. So we know that that's a good environment to go and invest in the technology space, and that then attributes itself to that theme of the macroeconomic outcome of the technological advancements and how that then might affect productivity. And then those are the companies that potentially supply around the world. So we take it through each of the different steps to go, well, these are our overall Ds, these are the themes that sit underneath them. Which asset classes would we then look at? And then within each asset class, going and identifying who are the fund managers that we want to pick that we believe are going to make the best calls in that space.
Perfect. It sort of follows on to the next question, actually. Someone's asked about your view on large cap US tech and your views on that. So it sort of follows on from what you're saying, really.
Well, I mean, we really think that there's going to start being a broadening out. And I mean, we're already starting to see it. Dare I say, NVIDIA had a small correction. I mean, it's very difficult when they've gone up by so much, but they did have a bit of a correction if we look at it earlier this week. And so there's always a place for large cap tech stocks in the US. I mean, no one's turning off their Microsoft anytime soon, but those companies then start potentially meaning something different. And so it's the innovation that we'd want to see continue out of those companies. But ultimately, what we'd really like to see is the broadening out, where we start seeing other areas of the market actually come out. And I think we're getting there. It's probably the beginning of the race.
And then a sort of final question, really, and again, it sort of follows on, is you mentioned in your slides that you use alternatives within your models. And how do you see that playing out going forward? Do you see yourselves allocating more towards alternatives or moving slightly more away from them?
So we update our strategic asset allocation on an annual basis, and we just did it now in April again. And like I mentioned earlier, when you start seeing the long-term expected returns on cash going up, that then has knock-on effects for every other asset class. And so we did see a small increase in our strategic asset allocation to alternatives in our latest rebalance. But it's the makeup of alternatives where I think it gets a lot more interesting. So we think about alternatives as risk diversifiers or return enhancers. And we're predominantly in risk diversifiers at the moment, which are hedge fund strategies typically. So it's trend following, it's macro strategies, it's event-driven strategies. So things like, if a big market correction were to happen, how do they then take advantage of that? And those tend to be your risk diversifiers. But the way that they work is they're taking advantage of market volatility, which means sometimes they do actually have great returns. And the one that for this last quarter in particular, and quarter performances again, I know it's very short term, but it was just interesting to see the tide kind of turn on some of these strategies, which have just been protecting really on the downside. One of our strategies that we allocate to did 15% return over the last quarter. To put it into context, we also use an HSBC America Index tracker, and that did 11% over the quarter. So although this is a hedge fund strategy which is designed to be, risk mitigating, it does also have the potential to generate alpha. And so that's really where we want to focus at the moment is risk diversifiers. We are on the edge of our seats waiting for the opportunity to go into return enhancers, but the roller coaster continues, right? We're supposed to be, how many interest rate cuts into this year? At the end of last year, it was 7 expected. Now we'll be lucky maybe if we get some this year. So there's still just so much volatility in the marketplace. And so we're sitting tight, we're holding on to those risk diversifiers, and we basically have the wait list of return enhancers to move into.
And then we've got a few minutes left. Actually, just a question from myself with regards to geopolitical risks that we have obviously ongoing at the moment, as you've touched on already. How do you, within your models, look to de-risk the clients or protect them from that?
Geopolitical risk is such a tricky one because it's impossible to predict. And it's something that you can never really be on top of and react to. I've had some clients ask me recently, what if World War III breaks out? Yeah. To which my answer is, I think we have bigger problems if World War III breaks out. But what tends to happen in these types of situations is the market reacts very quickly, and then it almost prices that in immediately because it's a shock to the system, if you will, and then things start to normalize. Now, what's very sad to think about is, we've had 2 wars in the last 2 years, and those wars are still ongoing, but the markets are continuing to go up. So we have to kind of separate these two things from one another. There is the initial shock, sure, and that's why diversification is going to be your best source of protection in those instances, making sure that you are diversified well across your asset classes. This is, again, an area where alternatives would typically do well in that environment, because if equities do take a big shock from that, that's when our trend followers and our hedge funds will position themselves to take advantage of that volatility. So that provides protection on the downside. But that diversification element is the only thing that's going to protect you in those shocks.
Great. Thank you so much. Thank you for your very comprehensive answers as well. I think it's really, more into from the slides, and then sort of get that more context around your thinking around it. And obviously the Schroder's models are all available on the Novia Global platform. So if anyone wants any more information on them, you can reach out to myself or Olivia or John, who's our contact relationship manager at Schroder's. So if you want any more details on that, please let me know. The slides will all be shared with you, and it's recorded. So I know with different time zones, people don't all dial in at the same time. So the recording will also be available via our YouTube channel. So all that remains is for me to thank Olivia for your time. The presentation was extremely interesting and thought-provoking. So thanks so much for your support. And thanks everyone for dialing in. We have another webinar in our series, which will be on the 22nd of May. And further details of that will be available via our Pulse newsletter. yeah, thanks everyone. Thanks, Olivia, and thanks everyone for joining us. I hope you found it as useful and interesting as we have. Thank you very much.
Thanks so much, Linda. Great to be here.